Hello and welcome. Today we are discussing Interpublic Group of companies, ticker IPG. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. This company is in the media industry. They have $11.4 billion market cap, $12.6 billion enterprise value. So you see about $1.2 billion in net debt on this business. Not that much compared to the overall size of the company. So they provide advertising and marketing services worldwide. 3 segments: media, data, engagement solutions, integrated advertising creativity, social communications, and experimental solutions. So I have heard of this company. This is basically an advertising company. So of course, advertising marketing. But there are a few, somewhere in the range of like 4 or 5 worldwide giant advertising companies, and this is one of them. So that kind of just gives you some ideas. So they have quite a few brands here: Initiative, Kinesso, Axiom, Huge, MRM, RGA. So they have these brand names, but really you think about it in the sense that they have this group of advertising companies, and then they make their profits by being creative, coming up with products to advertise for other companies. So they're going to be advertising for your big brands, your S&P 500. They're going to have contracts with companies like a Coca-Cola, like a Microsoft, like a McDonald's, and they would manage the brand strategy for those types of companies. Now, I don't believe those companies necessarily are tied in with Interpublic Group. You'd have to do your research to see which brands go with them, but that's kind of how these businesses work. Now, let's go to the return on invested capital. You can see that they did poorly in 2001, lost money. They did poorly in 2003, 2004, 2006. So they had like 5 years here of losses. But then after that, they've been profitable every year since 2007. So that's a pretty good sign. So despite the fact that they had all those losses, they've been improving steadily since then. They did take a hit in 2009. One thing with advertising that you should be aware of is the advertising industry sees large declines in revenue during recessions. So that's what you would expect. You see it again here, of course, in 2020. You had a recession in 2020, 4% return on invested capital there. But before the recession, they were in the 14% range, 13, 11, 9, 11, 11. So you can see that recently, since 2014, really, they've been able to maintain double-digit return on invested capital through that period, with the exception of the recessionary time of 2020. So that's a really good sign overall, and I like to see that in a business. I wouldn't say the total history here, these 22 years, suggests a high quality business, but I do know a little bit about what they do, and it's actually pretty good when you think about, hey, they have 15 straight years of profitability here, and the returns have been getting better over time. They've been improving, and now they're in that double-digit return on invested capital range that I like to see. So we see on the last 10 years, 11% return on invested capital, 23% return on equity. These are great numbers, would definitely indicate a high quality business here. Now, you have to think about these median margins differently. Normally you see median gross profit margins of 15%, and you'd be like, man, that's very low. But you have to understand kind of like how this business works. They're getting overrides sometimes on the overall advertising spending of their customers. And so you shouldn't necessarily be scared away by these gross profit margins of 15%. And the reason for that is you can see how close the EBIT margins and gross profit margins are. So their overhead is actually a very small percentage of the company, and that's only because of how their revenue is being structured. So just something to be aware of there. Now, the price to earnings ratio gets really interesting. You have a PE of 12 for a company that is, already said, high quality business here. Now, it's growing at 4% a year on assets or revenue. You're growing your revenue faster than assets, which would explain why you've had this improving return on invested capital over time, this sort of trend where you're getting better and better over a 10-year period. That's one reason you would see that. And then you'd also see this operating leverage here where your EPS has grown almost 10% a year, 9.7%, free cash flow 8.6%. When you're growing 8 to 9% on EPS faster than your revenue, that's showing the operating leverage in the business. We should see that in overall improving margins, and that is what you see down here. You can see that your margins have gone from 9.3% operating in 2013 up to 13% in 2022. So very strong signs overall with those improving operating margins. Now, you can also see here on these numbers a little bit of a change in 2015 to 2016. Your gross margins collapsed. This was clearly something different is going on with the type of revenue that they're reporting. Otherwise, that wasn't really make a lot of sense. But otherwise, you have some really good numbers here. Because the operating profit continued to improve over that time period. Now, let's go to the return on invested capital. You can see that recently, since 2014, really, they've been able to maintain double-digit return on invested capital through that period, with the exception of the recessionary time of 2020. So very strong signs overall with those improving operating margins. Now, you can also see here on these numbers a little bit of a change in 2015 to 2016. Your gross margins collapsed. This was clearly something different is going on with the type of revenue that they're reporting. Otherwise, that wasn't really make a lot of sense. But otherwise, you have some really good numbers here. So we have $2.37 here in EPS, trading for $30. So that matches up well with it being like a 12.3, 13 PE ratio. So good price here. I actually really like this price on this company. You're getting a high quality business for this type of revenue and EPS growth. Now, I'm immediately wondering, okay, you did see the operating leverage from operating margin, but I'm starting to think, hey, are they buying back shares? We need to understand some of their capital allocation there. But you can see that they've been spending, basically half of their returns in dividends here. So $1.16 in dividends on a $30 share price means you're getting about a 3% dividend. That's a very attractive dividend here. So all of a sudden I'm thinking, hey, high quality business, relatively cheap price, because you can do some quick math. PE of 12 is going to be about an 8% earnings yield. You're getting 4% growth. That's a clear path to potentially a 12% type return. 8% yield here. So if we say we have a dividend yield of 3%, and then we say we're growing our free cash flow at 8 to 9%, that gets you to an 11, 12% return as well. So we can clearly see the math to double-digit returns, which makes this company very attractive. Instantly starting saying, hey, this is probably a watch list type stock so far, because you can see the steady, reliable capital allocation as they've grown their EPS. It used to be 61 cents with a 30-cent dividend. Now it's $2 with a $1 dividend. So they're doing really well with ramping these numbers up, and I like what I see there. So overall, very attractive so far. If you're enjoying this video, hit that like button. Don't forget to subscribe. Let's go to the income statement. So yeah, you can see cost of goods sold really jumped up in 2015, 2016. I don't really know what's going on there. Oh, but okay. So what they've done is they've reallocated money from SG&A to cost of goods sold. So that's why this balance sheet looks so weird, is because what was SG&A in 2015 is now being counted in 2016 under cost of goods sold, because they still, you don't have a 90% drop in SG&A in a year. That doesn't make any sense. So really, if you want to analyze this company, look at the operating profit. That's the line you want to look at. And what I see is operating profit that's going up almost every year. 659, 788, 875, 936, 938, 1000. So like you're steadily improving your operating profit each and every year. That stability is key to a high quality business. I really like what I see. Now, again, it did go down a little bit in 2020, but not a lot. It was still really good. The big drop here was a one-time non-operating income hit. But otherwise, the actual operating profit of the business did really, really well. So good sign there. I had a question about buybacks, and it looks like we do have a buyback. We went from 430 million shares outstanding to 395 shares outstanding. So that's about 35 million shares bought back. It's a little less than 10%. So let's say 8%. You're going to get close to a 1% boost in your EPS growth just from those buybacks. Well, let's look at the balance sheet. Although it kind of has, leveled off in recent years. So not as many buybacks recently. Balance sheet, let's see. PP&E is low. That's not uncommon for a business like this. It's really, you see all this goodwill here. A lot of their balance sheet is this goodwill. I mean, $5 billion is goodwill. So it's past acquisitions, $800 million here in intangibles. So a third of their balance sheet is there. So what that means is if you pulled that off, your actual return on invested capital will be much higher, 15% plus. Really good numbers because of all that goodwill that's being embedded in the business. They don't require a lot of PP&E to run this business. It's going to be a business because it's about creative work from employees. Their greatest asset is their employees. You see this accounts payable number here. That asset of the employees is what really matters. It's not going to take a lot of capital to run this business, and I don't think it will much in the future. They're offsetting some of their PP&E or more than their PP&E in long-term debt. I think you're going to see, no inventory again. So this is a really good business in terms of being low capital intensive nature. Now they have capital leases added on here. Let's go to the cash flow statement. So they have stock-based compensation. Now, I don't like stock-based compensation. What you see with this steady stock-based comp, is it leads to increases in shares outstanding. So they bottomed in shares outstanding in 2018, And then they kind of steadily grew back since then over a 5-year period. Now, that happens because they had stock-based compensation here, and then they bought back stock until 2018, and then they stopped. And so you had 3 years with no buybacks, and so then the shares start rising during that period. Now, because your greatest asset in this business is employees, it's not very capital intensive. It makes sense that you have stock-based compensation here. I don't like it. I'd prefer them to be paid in cash, but most likely they have to do this for competitive reasons. If your competitors are doing it, it's going to force you to do it. I'd like them to pair that with buybacks, but it looks like they just couldn't do it for a few years. But they've started back up again, so that's a good sign. Overall, pretty good use of cash coming in. You can see a lot of that money is being spent on buybacks and dividends. 320, 457, in some cases more than their cash flow from operations. What is this working capital changes? Big working capital changes here in this year. Depreciation and amortization is actually higher than PP&E in a lot of these years. Why is that? I think it's big acquisitions playing a big part in that. Otherwise, they matched up pretty well. Basically, it's a pretty good approximation. Your net income is a pretty good approximation here of their cash flow because of these numbers matching out, especially when you take into account some adjustments for stock-based comp. Overall, pretty good capital allocation. I would say that Interpublic should go on my watch list. It's a very interesting business. I like these advertising industry businesses. They have very low capital usage. They have highly reliable cash flows, and their cash flows are usually allocated into a good manner. They're used to pay dividends, they're used to make buybacks, and they're still able to grow. You think about the fact that they're able to have a 3% dividend yield in this market, trading at a PE of 12, but still growing at 4% plus a year on a revenue basis. That's pretty good. That allows, even them being a big S&P 500 type company, them to earn double-digit returns pretty easily. You can see how they can do that over a long-term compounding basis because you're getting in at a good price. So I think this is a good price for the company. It's going to go on my watch list. It's a high-quality business. And so I like it. If you learned something in this video, hit that like button. Don't forget to subscribe. And if you want to use the software I'm using, quickfs.net, my affiliate link is the first link in the description below. Please consider using my link. It's a great way to support the channel. You can get a free or paid account there, and when you sign up, I can get a commission for sending you over there. Doesn't cost you any extra, but it's a great way to support the channel. Thank you for listening, and until next time, stop paying fees, start building wealth.